Welcome to K.S.Rangasamy College of Technology. I am Sabarish, Assistant Professor, Department of Management Studies. In this video, we will be discussing about the Introduction to Financial Management. Introduction to Financial Management. In this unit, we discuss about the meaning, nature and scope of financial management, role of financial manager, risk and return of organizational functions of financial system. First meaning, how blood is important to our human, as like that finance and financial management is important to the business. Meaning of the business finance is that business activity which concerned with the acquisition and conservation of capital funds in meeting the financial need and overall objective of the business enterprises. Financial management is concerned with the managing of financial resources in most of the optimal manner. Its financial management helps to find the most cost effective and financial resources need to carry the operations. Where to invest the scarce business resources to maximize the return in our investment we made in the business. How to manage the routine production distribution in the finance most optimal and cost effective manner as to maximize the wealth of the stakeholders. Definition of the financial management. Financial management is concerned with the management decisions that result in acquisition of long-term and short-term of firms. Then next topic is nature of financial management. It is an indispensable organ of business management, and also this is different from the accounting function. It is also centralized function. Financial management helpful to decision making by the top management to source of fund from the different sources. It's also applicable to all type of concern. It's need financial planning, controlling and follow up for the financial managers. It's related with different disciplines like economics, accounting, law, information and mathematics. Next, scope of financial management. Scope of financial management is undergone with the over years. It is scope was limited to the procurement of fund. In modern times, the financial management includes, besides procurement of fund, in the three different decisions, namely investment, financing and dividend. In scope of financial management, total requirement for fund for a given period is most important. Investing fund in both long term as well as short term in capital needs. Managing funds and treasury operations in financial management is most important thing. Payment interest on borrowings, repaying lenders on due times. This is most important in the financial management to run the organization. Maximization of the wealth of stakeholders for the long time. It helps our organization to improve and growth for our enterprises. Awareness of the latest developments in the financial market in the societies. Increasing firm competitiveness, financial strength in the market. Next topic is role of financial manager. First one is mobilization of fund. The financial management helps in effective utilization of sources of finance without wasting them and getting the maximum benefit from the available resources in the organization. The financial manager responsible for managing the different sources of fund such as shares, debenture, bonds, loans, etc. Second one is deployment of fund. In order to meet obligation of a business, it importance to have enough cash and liquidity in the organization is most important thing of the financial manager. Third one is control over the use of fund. The finance manager must decide how much money is needed, when it is needed, where it is needed to improve our organizations, how best to use available of fund and how to get required financing in the organization. Fourth one, risk return trade-off. Risk return trade-off means the financial manager to maximize our shareholder wealth would strive to maximize returns in relation to given risk. To ensure maximum return, fund flowing in organization out of firms consultancy monitored to assure that they are safeguarded and properly utilized. Fifth one is increasing the overall wealth of shareholders. This idea of maximizing shareholder value comes from role of corporate governance in the societies. Corporate governance involves the regulatory of marketing risk involved in the trade-off to the management, board of directors, shareholders and stakeholders, and the goal by which organization of the corporation is governed. Next topic is risk return trade-off. It means the risk return trade-off. To calculate the appropriate risk return trade-off in the organization, from investor must consider many factors including overall risk tolerance and potential to replace loss of fund. It's including the risk return trade-off in the trading principle that links with the various risk and reward of the organization. Risk return trade-off consisting of both higher risk and the lower risk. Higher risk means higher probability of higher returns. Lower risk means lower probability of lower return. It means if the investment or the risk is high, our profit, our potential, our probability is also high. Our investment is low. You just take only low risk means the return should be in the low level. Okay, that is risk return trade-off. Next one is organization functions. An organization of finance function. It means the finance function is very vital role in every type of organization that gives more sound and effective in the organizations. We were aware about the organization activities of an organization as well as organizing the activities within our functions. It is necessary to step up as sound and effective organizations. The organization varies depending upon the nature and the size of the organization. Though we can't have the standard organization for all the enterprises, we can structure basis on the mentioned chart in this PPT. First one is shareholders, then board of directors, then managing directors. These are the three topmost level in the organization. Then it comes under the production chief, marketing chief, finance chief and human resource chief. In this unit we are discussing about the finance chief. That controls of majorly divided into the two based on the organization. First one is a finance controller, then treasurer. The duty of a financial controller is to preparing the budget, tax management, internal audits and annual reports. The treasurer depends upon the cash management. The main role of the treasurer is to cash management, credits and receivables management, banking relationship and fund securities. Financial controllers, it's preparing the documents. Treasurer is to managing the cash. Next one is an functions of financial system. The function of financial system, first one is the saving function. In saving function, find their way into hands those who have in production through the financial system. Financial clients that are issued in the money of capital markets which promises in future cash inflows and outflows of the business. The funds in hands of the producers resulting in better goods and services and increasing the societies in living standards. Liquidity, second one is a liquidity function. Liquidity function is deals with the money in short terms, money in the form of deposit offer in least risk of all instruments. So a cash deposit in the bank, it is a very less risk in the business. Value mainly by the inflation of the business. We have two major liquidation process in the business. First one is a greater level of risk involved, and second level is an degree of liquidity, that is conversion of clients into the money. Third one is an payment of function. In this function, financial system offer a very convenient mode of payment for goods and services. The check system of the credit card systems as like that easiest way of charge in the economy. They also reduce cost and time of the transaction. Fourth function is risk functions. The risk functions involves the financial markets provides protection and against life, health, and income risk. That accomplishment through the sale of life, health, and property insurance policies. It helps the investors to hedge himself against or reduce possible risk involved in the various instruments. Fifth policy is policy functions. Most government interventions of financial systems to include the macroeconomics in the interest rates of inflation. For example, the federal or central bank invests in several cuts or CRR and tries to decrease the interest rates and increase the availability of credit at the cheaper rates in the corporates. Thank you for watching this video.
Thank you.